there's a picture in this article of him in a crazy fencing outfit in his mansion in Hawaii, in the metaverse fencing some Olympic gold medal, and it just he looks like the Marshmallow Man or something.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
I have Calvin Brodus flowing through my mentals on the daily. You know Calvin Brodus.
Yeah, I know we're going to talk about boomers later, and you might want to save that reference because there's people on the pod that don't even know who that is.
So Snoop Dogg, Calvin Brodus is his real name. And I say Calvin Brodus specifically because back in the 90s, he had this song because he was on trial. So that's how like his real name was coming out everywhere. Murder was the case that they gave me. You remember that joint, right? But I think every day I'm like, inflation was that case that they gave me. Every day I'm thinking about that. Every day I'm thinking about that. How you doing, man? How you doing?
Oh, I'm good. I mean, we've been talking about inflation. And remember my $14 burrito? And then you had like this egg salad type thing. No, it's like a breakfast that they smashed up for you and charged you $15. Remember that?
Exactly.
Gourmet eggs.
Yeah. I remember.
Well, one of our friends, who's not our friend at all, went on Fox News to talk about inflation this week. Can you play that clip for me, Douglas?
Yeah, I'll put this on.
I mean, admittedly, you want to know how bad inflation is? Yesterday, yes, I had a nice lunch at Taco Bell. Cost me about $28 at Taco Bell for lunch. People need to pay for those things, and they do that by getting jobs and getting in the economy and getting active and getting involved.
Wait a minute. You spent $28 at Taco Bell for just yourself?
For lunch, yeah. It's true.
Okay.
That's a lot of chalupas.
That's an inflation story.
That is. You're both thin, fit guy. I can't see me. That's just like the opening appetizer, but whatever.
I just can't. You might have seen the headlines on social media, right? And I was like, whatever. This is not going to be worth my time. I cannot get over how funny that is. The reaction of like, wait, first of all, he says, I had a nice lunch at Taco Bell.
Yeah.
How do you have a nice
straight face too?
And then I've probably mentioned this on the pod before. My family of four kind of likes Taco Bell. It's like the guilty pleasure for our family. I'll get a nice meal in quotes, for the whole family for $28. I cannot even imagine how you spend $28 to talk about.
I love his, and maybe his comedic delivery is what frames this, but it doesn't seem like he's joking. Like he has a straight face on when he's saying
so
this.
serious.
Like I sat down for a nice lunch, and then injustice ensued.
The other thing that cracks me up is like, I mean, there's prices on the menu, guys. Like you can't be that surprised, when you go order, you're like 3 double steak quesadilla tacos, 2 chalupas, 7 sodas. I still don't know how you get $28.
I like how sodas was the thing that you like.
Because you need like a $3 piece of garbage to. I don't know how you spent $28. Anyway.
Okay, while we're on this topic of things that you cannot believe, I read this Wall Street Journal article this week and took a triple, quadruple, quintuple, sextuple, septuple, octuple. I was trying to see how long I could go. I was actually pretty impressed with myself right there. So I took this double take on this Wall Street Journal article talking about diversification, which I think is very interesting. It can be important for a lot of portfolios. The article is called "Here's a Different Way to Think About Stock Diversification." And here I am in my naivete saying, oh, I'd like to learn about a different way to think about stock diversification. And so I began to read this article. What it talks about is, instead of thinking about diversification, or maybe in addition, let me not say instead, in addition to think about stock diversification from holding different types of investments so that you can diversify your risk, it says think about it from a time perspective. So usually people might say invest X percent, like a certain percentage of your portfolio, right? You do that from the time you start working. And because your income generally increases over time, you end up investing more as your age progresses.
Yeah, you mean I think you misspoke. You mean a certain percentage of your income. Typically, that's somewhere between 10 and 15% of your income. If you set that aside for retirement, you're going to be in great shape in 99% of scenarios.
Yeah, sorry, I misspoke there. Thank you for clarifying. Exactly. So it's saying, whoa. If you do that, you're increasing risk later on. Let's not do that. Instead, invest the same amount from the get. So always, instead of investing like $1, just proverbial $1 here, $3 later, $5 later, just invest like two or the equivalent of like $2 or $3 all along the process. So I'm going, that seems interesting. Okay, go on. So I continue down the page, and it says, now, Doogles, what you might be thinking is, how can I do that? Because I don't have the money early on. This article says, we have a simple solution for you. Borrow it. And I went, hold up. What you were telling me to do is at a young age, and potentially right after I just got off of having student loan debt, you're telling me to then add in margin debt in order to fuel my stock market fancies? I'm gonna just get your reaction right now.
I mean, this is hot garbage, but I'm running out of ways to say garbage. So I started saying sewage this week at some of the stock ideas you were sending my way. I mean, whoever thinks leverage is a good idea? Leverage is guaranteed pain, right? Just guaranteed pain. This also assumes it's hard enough for people to manage their own behavioral expectations and emotions that come with significant downward swing in the stock market, right? It's hard enough. Can you imagine if you're levered up, if you're making $50,000 a year because you're fresh out of college and you're trying to buy a house and you're trying to, get on firm financial footing, and the stock market happens to do what it's done this year and go down 25-ish%? Like, you're going to be freaking out. You're not going to say, oh, I read this article in the Wall Street Journal from some Yale professors and everything's going to be great 50 years from now. Absolutely not. You're going to be trying to live your life, trying to buy your puppy or whatever, and you're going to be up to your eyeballs in debt, not being able to get a home loan. Like, this is hot garbage. That's all there is to it.
Yeah, I mean, I couldn't believe this was in the Wall Street Journal. And to your 50-year point, right, it's kind of saying, I'm going to butcher like the full argument they have, but it doesn't really matter. It's kind of saying, well, the stock market goes up and to the right, and so we've back tested this, and if you leveraged, you would have had more over. Yep. Who was their editor? I can't even blame the authors for this, right? Like, who was like, yes, this is the portfolio theory that we should put out there. We should go ahead and say, Yale professor, because you're from Yale, you're probably right. I blame the editor at the Wall Street Journal that said that we're going to put this in our period. I can't even call it a periodical anymore.
Well, so let me read a quote. Using an additional 200% allocation and gradually reducing the allocation to stocks over time down to 83% at retirement age is a winning strategy. In a 2010 book, we found that the leveraged life cycle approach produced superior retirement accumulation for each and every cohort retiring between 1914 and 2009. Of course you did. You took on leverage and the stock market went up. Like, of course you did. This is the people at Google and Facebook and Apple in the last, well, take Facebook out of that. Let's just say Google doing analysis of their stock's performance for the last 20 years and being like, well, pretty much every investment we've made has worked out. Well, because your stock's gone up and to the right. Then that works until it doesn't work anymore. And then you completely screwed and you took on leverage.
Precisely. I just, like, I couldn't. So we can move on. Don't need to spend more time with this, but you can do better, WSJ. You can do better. What you got?
I'm gonna sue them for
okay, hold on.
for malpractice.
You just got straight American on us right there.
Oh,
Man,
I
what
did.
you got in the bowl?
Cathie Wood wrote an open letter to the Fed this week. I'm not going to spend time on the open letter to the Fed, but I think the translation is something like, Jerome Powell, my stock picks suck because I bought a bunch of stuff that had no cash backstop, and now I'm in a bad spot. Could you please help me out here with some rate cuts? Is that what it said?
I mean, so is that the purpose of it? Yes. What she said here, I'll spend a little more time on it.
Okay.
What she says is the Federal Reserve is spending too much time looking in the rear view mirror at lagging indicators. We should look at forward-looking indicators. And so she includes this table of commodities and saying, if you look at commodities, which are forward-looking in her view, commodities are decreasing in price hugely, bigly, right?
Yep.
We got commodities going down by 30%, 40%, 50%. I don't have the table in front of me, but I remember like there were huge numbers, right? Commodities.
Yeah, I do.
down.
And I own a lumber company, right? And so the price of lumber has gone down 74% from peak to current price, like in the past 6 months. Drastic. It's happening all over the place in commodities.
So she's saying commodity price has gone down. So inflation is definitely going to come down. It's just lagging. So you haven't seen it yet. And the second point she brings up is around inventories, which we've talked about here. She's like, if you look at inventories, Walmart, Target, you got these companies that have bomb supply chain, and it's like they're very good at managing the supply chain, is what I'm saying. And if you look at their inventories, obviously we no longer have that supply side inflation situation going on because they're able to get all their inventories, but they're not able to sell them. And so we knew this was a supply chain problem previously. That problem doesn't exist anymore. So these are the things that Cathie Wood saying. You're looking in the rearview mirror. You got to look forward, Fed. You got to look forward. Inflation's already coming down. You just haven't seen it yet in your data.
Deep breath is my response to that. I will tell one aside. Remember when semiconductors were impossible to get and there was going to be a 3-year supply shortage and everything else? Well, now semiconductor companies are in the middle of layoffs because of how much oversupply they have and how weak demand is. So everything mean reverts. At least that's my take. I think that's some of what she's saying here. And I agree that the prospects for inflation are better right now than they were 9 months ago. But that does not mean you can take your eye off the ball. I don't know. I have a hard time giving credence to these words because I just see through it, whether it's right or wrong, and say what she's really saying is my stock picks have performed very poorly recently, and I need all the help I can get. And so might as well ask Jay Powell.
She's petitioning to the UN right now.
Effectively. Yeah, she probably wrote the article that says you can't raise rates that we talked about last week.
The part that you're going to like the most, though, like this is your favorite part because of what you brought up here before, is the last sentence that she has in this thing. Here we go.
You think I made it to the last sentence? Absolutely not.
All right, here's the last sentence. Could it be that the unprecedented 13-fold increase in interest rates during the last 6 months, likely 16-fold come November 2nd, has shocked not just the US, but the world and raised the risks of a deflationary bust?
And how do you do the math in Europe where the rate was at negative 0.5% to whatever it is now? How do you do that math? I don't know how to calculate that, but that's what she should be writing about.
I mean, look, when interest rates are zero and 9 months later they're still zero, do you say that you had 100x fold or 100x increase in inflation rates? Here's the whole thing. So there was this point, right, when Cathie was talking about how her portfolio is going to increase by 40% a year, all this kind of stuff, and she was saying, I know this because of our models. Our models spit it out, and our models are so good. There was a part of me that said, I mean, what she was saying was all the garbage in the world, right? Which you've heard me talk about before. There's a part of me, at least, that was I mean, she probably does have these models. They're probably sophisticated models, and they're just spitting out things that she decides to put out in the world that's nonsense. Now I'm doubting the models. Like at this point, I'm kind of like, you can't, like the way that you perceive math, right? Like you need to go talk to Archimedes because you need to get down to the basics.
We know that from her 13 times comment. I don't think I could spend any more time on this.
Here's what
okay. No, I actually can. When you were so bold that whatever a year ago you said my portfolio is going to compound at 40% returns for the next 5 years, which would make it like worth however many trillions, and literally the math was impossible at the time. Those models that you're just claiming you liked were around. You just have lost all your credibility to go back and say, oh, Jerome Powell and team, you should listen to me. She just loses more credibility every week. Sorry, I don't like throwing shade. I'm not trying to do that. I'm just saying don't listen to her advice because it's not worth listening to.
Hold on. I'm not throwing shade. I'm just saying don't listen to her. Like, is that
I'm saying don't make investments based on her guidance. Yeah. Okay. Nope. I think that's a fair public service announcement.
I think it's more than fair. Than fair.
Good.
I'm gonna put beside this because I think these two things go hand in hand. So we got Cathie Wood yelling at the Fed, "You're doing a bunch of nonsense, Fed. Please change your ways." And she's not the only one. There is this investment letter, I'll just kind of call it, that was put out by Strategas. I think it's got to be pronounced in a fancy way. It's called Fed to Financial Markets. It's Not About You. Mm-hmm. And it's short, right? This isn't one of those long ones, but I think it's like it's just so straight up and good, because what it says is people need to stop complaining and play the game on the field. I'll give you a couple quotes as to how it says this more articulately. At the start, says kind of like what we were just talking about. It's not often that you hear a professional investor pine for a financial crisis to bail them out of their long duration, long risk trades, right? Which is what you were saying, Cathie Wood is basically trying to do. It's like,
yes.
It's almost as if money managers are taking the Fed's tightening campaign as both a personal affront and a crime against common sense. Boom. I think sums it up. People be complaining and they be yelling everywhere. Okay. Now, this is where you get through the whole thing. This is the summary of what they're saying. We, on the other hand, believe it makes more sense now to simply listen to the Fed tell you how it's going to proceed, regardless of whether one believes it to be right or wrong. As in blackjack, the object of the money game isn't to get 21. It's to beat the dealer. We must all play the ball as it lies, accepting the world as it is, not as we wish it to be. Mic drop. Strategas.
Yeah, there we go. That much better. That's what I'm trying to say to Cathie and friends. And they just said it in a better way. Much better.
That's it. Like I think the point that they raise in this is so good. They're like, you could send me your commodity tables, send me all that. Great. The Fed has, with no doubt, just stated, we are taking inflation down. We know that this can and likely will cause pain. We're taking inflation down. Play that game. Don't play the game of like lumber's down 70%, and so therefore you shouldn't do this. Like, nah. They've been very clear.
Yeah. I keep trying to get away from Cathie and I keep coming back, but Cathie's over there screaming, oh, you have a chance to rethink what you told us was going to happen in November. When the right thing to do is be like, this is amazing. They told me exactly their playbook in November, and I can make decisions based on that. Like, that's what you hope for as an investor. In this way, you almost know the future of where they want rates to be through the end of the year, and you can make smart decisions about it.
Exactly. Just like look at the data, and it's not very often that there's this much clarity from what they've stated, and they seem pretty freaking resolute about it. The other thing that gets to me, I know we've said this a little bit before, the other thing that gets to me is we wait for these inflation reports, these CPI reports, and I don't really know what we're expecting to happen that fast. Like the amount of, I'm gonna way oversimplify the economy, and also I'm gonna this isn't really how CPI is calculated, what I'm about to say, but still, let's just use it as a narrative. So what needs to occur is you raise interest rates, then people have to say, instead of spending that, I'm going to save it, right? They're going to have to say, instead of spending, I'm going to save it. So you take money out of the economy, you put it into your savings account, because now you're getting interest rates. The restaurant down the street has to go, I have my $22 entree, but now I see that demand's going down. So let me actually lower my price from 22 to 15, or whatever the price should be there. That takes like a good amount of time for that behavioral change to go through the economy. And again, that's not exactly like really how it works, but the expectation that we have that the Fed raises rates and like within the next 6 months, everything falls, it doesn't even make any sense. Right. I'm my way too oversimplifying. What do you think?
No, you're just articulating the mistake people frequently make, and that's having perspective that's much too short term. Whether this is investing or watching CPI print on a monthly basis, like it is going to take a year. If you go back to the Stanley Druckenmiller interview where he said, I had my massive team of analysts look at all the situations like this, and until the Fed funds rate is greater than CPI, you basically never get inflation under control. I know that Jerome Powell and team have done a very similar analysis, and I am confident that that's why they are so steadfast in the plan to continue to raise rates, despite the fact that they know that that's going to cause pain to the economy, because that's what has to happen here. And so I'm with you. Yeah, I don't really care what happens on a monthly basis. I can tell you if things continue at their current pace, it's going to be much better 6 to 9 months from now than it is today.
There it is. All right. What's next for you? Well,
so on our podcast sharing app, the thing that like publishes to, Spotify, Apple Podcasts, everything else, it keeps asking me if we're a comedy podcast. And I think that's kind of funny. So I just feel like I have to live up to that mandate, Doogles. And the best way to do that is to talk about Zuckerberg. Do you know that he shared a picture of him in the metaverse in like August? So first of all, the New York Times and the Wall Street Journal did like tear down of how chaotic the metaverse is at Facebook right now, which are fun reads if you're a shareholder like me. And so he released this picture of him in the metaverse, and people ripped it to shreds. Like, just said, this is the stupidest thing I've ever seen. It looks like something from 2002. So then, if you believe the reporting, he had his team do 43 revisions of what his face looked like in the metaverse to share the update.
Here's like I did not mean this as a pun, but I was about to say here's the meta problem. But I just meant here's like the higher level. The higher level issue here is Mark Zuckerberg decided that he should be the face of the company.
Yes.
Now, I know he's the CEO, and I really, this is a hard thing to say, like, and not to mean in a negative way, but I really don't mean this in a negative way. But like, nobody likes you, which can be fine. You need to run a successful company, right? You need to have the respect of your employees. You need to, there's a lot of things that you need to be able to do. You don't have to be broadly and publicly liked as a CEO. Like, I think that's fine. That's why I don't mean it to be a negative thing, but you should know that.
You don't need to be like George Clooney or David Letterman or someone that is fairly universally liked. There's a picture in this article of him in a crazy fencing outfit in his mansion in Hawaii, in the metaverse, fencing some Olympic gold medal. And it's just, he looks like the Marshmallow Man or something. Like, hire, go pay George Clooney $5 million to do this exact same thing, and people are going to be like, wow, that's cool. It's a great point. Why does he think he needs to be the face of this? Why do we care about him fencing or him surfing or whatever he wants to do in the metaverse? We care about people that are more relatable and how they would use some very cool technology that his company happens to own.
Do what you're best at, right? Part of my rationale for thinking that I want to call it Facebook, Meta, can do the metaverse thing. Part of my rationale is that Zuckerberg is a really strong operator. Like he's really strong operator. Not he's such a charismatic, likable, like I want to see his face everywhere guy. Like you need to spend your time on your most valuable, like high ROI stuff. Zuckerberg, this is not it. You're just going to end up creating more kerfluffle and having to fight it. Right? I don't need you doing that, right? I need you like in the company making your employees more productive and, you know, creating value, whatever. Just get out of this. I don't know if maybe this is like a reaction to Cheryl leaving or something like that, that he feels like there's a void or something. I don't know, but
that's
you just
an
got to stop
take. One of the things I liked about the article this week in the New York Times was it did talk about how he made a major bet. I think it was 2012-ish, where he said everything we build in the company is going to be mobile first. And that was a dramatic change at the time. And he was 100% right to make that bet. It made the company tons of money. I think we'll see if he's right on this bet or not. But, you know, that's a really great point, Douglas, that I haven't even thought about. I think I just laugh at his public persona and how he has become the face of the company in a way that distracts from the actual products. So I love what you're saying there.
Hopefully he gets back to it. All right. Can I talk about a company that I came across this week that I think is really interesting? I'm reaching down in the fishbowl to talk about Built With. The name of this company is Built With. Built With is it says no employees in what I read, but there's one employee. It is the founder, CEO, employee. Makes, according to this, $14 million a year with that single person. And what I thought was most interesting is how this product and organization was built, what it does, and how it makes money. I'm going to give like the 1 minute recap of what that is, and then want to hear from you. Okay, so it's called Built With. The reason it's called Built With was because something like 16 years ago, so back in the 2005, 2006 time period, there was this lonely person that wanted to be an engineer. And he said, all right, so I'm going to learn how to code, and I'm going to build me some apps, and I'm going to make a lot of money. That's the way this works, right? And so what he did was he said, well, I don't really exactly know how to code right now. So let me go and I'm going to get ideas and learn how to code by looking at the source code from websites. And so what you can do, if folks don't know this, if you go to a website and you right click on it, you'll get your right click menu, and you can click on inspect element or inspect, depending on what browser you're using. And that'll allow you to see like what's happening in the background. So you can see the like HTML source code. You can click through to like the JavaScript. They have you all this stuff, right? You can take a look. And so what he was doing was going across websites, right clicking and looking at what technologies and whatnot all the websites were using, and started making this database of it. And so he built a bunch of apps like he wanted to. None of them worked. But this database that he was collecting started to be like pretty freaking valuable, right? Because it's so proprietary. And so eventually I'm skipping to the future a little bit. Eventually he has this proprietary database that has, I'll say, every website, right, on the internet. Not exactly, but it's like every website on the internet. It links to what technologies they're using, what type of code they're writing in, all this stuff. So he creates this, and people start liking this because it's interesting. The creme de la creme, what I love, how he makes money, is that then he started charging for it, not because people thought that it was interesting to see what other websites were using, but because you can see who your competitors are and who's using them. So an example would be if I said, I want to start a Slack competitor, right? I can go, that might be like the worst example actually, but anyway, but if I said I want to start a Slack competitor, I can go into his database and see all of the organizations that are using Slack, and then say that's the customer base that I want to market to, right? It's like, it's pretty ingenious, I think, having this database and then that as a use case. So $14 million a year, a single individual, I think it's pretty fascinating.
Such a cool company. I stumbled across it like 3 months ago, and just the their interface and the ease of use is pretty cool. I love the story. The story reminds me of the reference we made to Annie Duke's new book, Quit, because the piece you missed is at one point he hired a co-founder and was thinking about like scaling up. And he made a conscious decision that they were getting nice organic growth and they didn't really need marketing. Like the people that need this find it and they're willing to pay him money. And so he pulled back and said, this is effectively going to be a fully automated $14 million a year company. And that works for me. I think that's the most admirable piece here. Well, actually, I mean, the story of how he built the company is also really cool. But I love that he took a different path here. He could very easily, I'm sure, be $100 million company with $97 million in expenses and feel more important, have a bigger office space, but probably like make less money at the end of the day.
Sometimes the next big thing is the big thing you already have.
Well said.
I think it's like super cool. And I love that you relate this back to the Annie Duke piece. I mean, it's not easy, right? When you're in an organization to say, yeah, let's not go for the big win, but this just seems like why mess with this? It's really interesting. And at some point, maybe, it stops printing out the returns at some point. But by that point, the ROI he's had on this will already be like pretty freaking massive. So like kudos. I really loved reading about this.
Oh, right now, all his financial metrics are off the charts. And as I told you, Doogles, I'm happy to pay him $1 million per employee to buy his company.
Let's see if he accepts.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doogles Show.
We have 2 pieces of listener mail this week. I'm not sure if we'll get to both those, but thanks for sending that in. Hit us at skippydoogles@gmail.com, excuse me, with listener mail. So the first thing comes from a tweet by Connor Sen this week. And he's joking here, but he says, my real estate genius was being 36 years old and having 1 kid with plans to have another in 2017, buying a house before the pandemic and then refinancing last summer. Thanks all to my parents having me between 1981 or in 1981 instead of 1989. Let me translate because I want to be crystal clear. This is an economics joke about the timing of your birth drastically influencing your economic opportunities simply because of luck. Simply because if you were born in the early 80s as opposed to the late 80s, you came of age at a time, you got to that mid-career time where you're ready to buy a house that happened to coincide with house prices being cheap and mortgage rates being low. That person is likely significantly better off from a financial position than someone who is born 8 years later. Thoughts, Doogles?
I think that, as you stated, time period of when you come about can influence a lot of what you're doing here. I think that the decision point here, I think, can be easily ignored as well, because you can just decide not to. If you were born in 1989, you can decide not to buy the house at that point in time. So that's the point that I think is ignored. But the key point around, as you brought up before, you just mentioned, if you were raised during a certain time, like Great Depression, that changes your whole psychology as to how you approach stuff. I think that's like dead on. And if you're born at a certain time, having access to certain types of vehicles, like investment vehicles, right? Tax law changes, all that kind of stuff. I think it could be highly influential. So agreed to the broader point.
Yeah. So the listener mail here is just how to think about this. And I think the way I think about it is in all walks of life. I always think about the founders, the Steve Jobs, the Bill Gates, and how much luck went into the fact, even the Jeff Bezos, like Elon Musk, and then that on a smaller scale. If you really think that 100% of your life's outcome is driven by skill, you've just completely missed the boat. We can go back to the Michael Mauboussin book that specifically talks about the difference between luck and skill. He breaks it down on different sporting events, hockey, basketball, football, everything else. He talks about investing. That's the overarching point for me, is never lose sight of how much luck is involved with the outcomes of your career, of your financial life, of who you even meet and marry. Like that's just part of the equation that you can't forget about.
Agreed. And I'm going off on a tangent here, oddly. Going off on a tangent. We were talking about that FDR book last week called No Ordinary Time. I was talking to a friend about it, and I was like, how lucky as a country were we that, and this is double luck, that during this period of time, we had Franklin as our president. Like, if you look at what he did, like how lucky, the double luck comes here. And how lucky were we that we had him as our president and that he married Eleanor. Like, the combination of the two of them is so ridiculous, right? And again, it's a tangent, but these are the kinds of things that I think you can sometimes just overlook.
Completely agree.
Big luck.
The other piece of listener mail we had was simply about cash allocation. And we're as guilty of this as anyone else, right, Doogles? We're always talking about, I see a new deal in the market and I'm ready to deploy some cash towards that deal. And the listener mail was effectively along the lines of like, but where do you guys get this cash? Like, I'm invested. I made an investment decision. Maybe I rebalance once a year. Like, and the money I have is allocated. So where do you get more money when you see a deal on the street? How do you handle that? How do you think about that?
So it actually, it's I think it's like a phenomenal like point actually to point out, right? Because I think the statement is around, there's not some like bucket of cash that most times that people are saying, I'm just waiting for a certain moment and sitting on my Scrooge McDuck pile of gold coins, right, to throw in. For me personally, it's pulling out of savings. And so like I'll just, not always, right, but I'm just going to keep it simple. So there's like the amount that my family says this is no touch, right, emergency fund. So that's like no touch. And then there's savings that exists it's not quite no touch, but it's like meant to be like longer term. It's not meant to be invested. But during certain times, when you do the math, when I do the math of looking at like the savings rate or whatever, depending on where it is, whatever it's getting long term or a certain type of deal, it takes from that. That's like most of it. But then there are other times where it depends on the size of the bet that I'm making. It's just like, this is a worthwhile, like it might come from like the next paycheck, right? That kind of like goes into it or whatever it might be. So it depends on the size of the bet, but those are like the two places that typically comes for me. There is not an investment pile that's sitting in my brokerage account, right? That's just waiting to be deployed.
That's the point I wanted to make. I mean, really two things. One is, I think very much we are pretty much fully allocated. We have our emergency fund, we have our savings, we have stuff in cash, we have the kids' college funds or whatever, but we're effectively fully allocated with our investment philosophies, because you should be if you want to make decent returns. If you're sitting on a big pile of cash, that's going to come back to bite you over the course of 40 years. But I get pretty creative and I get excited about deals in the market, as everyone that listens knows. So I'll even like think about, hey, maybe instead of going out to eat and spending $100, maybe I should divert those funds to a cheap value stock that has a 7% dividend. Like, we're at the point now where there are deals I get excited about, and I'm actively thinking about ways to take funds that would end up in other places and divert that into investments that have me excited. That is really fun, because that hasn't been the case for the past 6 or 7 years. Like, there was nothing that I was like, oh, maybe I should skip this sporting event or whatever, or maybe I should generate some more cash around the house to invest. And I'm getting to the point where I go, oh man, my life's going to be so much better off if I take $100 here and $100 there and $1,000 here and $1,000 there to deploy into things that I get excited about. Does that make sense?
Yeah, I do think it makes sense. And one thing that I want to throw out there is, you were talking about how like it doesn't happen very often. And I just want to hammer that home, because the point, at least from my vantage, and I believe you'd agree, we're not saying every time that you see something that you want to buy, throw like the amount at it. It's a rare occurrence. Typically, I invest once a year.
Yep.
Like typically according to the model. However, in 2020, these are like rare times, right? In 2020, that was different. And right now, that's different. Right. And so because there are not even necessarily that the market as a whole is cheap or anything of that nature, but there are deals that respectively between the two of us, we think from a long-term horizon perspective, this is a time that's worth starting to like invest in some things. But it's not like, every month, every week, we're watching for things to throw money at or whatnot. I just want to make that really clear.
Thank you so much for doing that, because it is very important to understand that this is maybe once in a decade for me, where I feel like I can invest in a stock that might have a 7% dividend, that might have easy upside of 2 to 3 times. So I just in the back of my head am going, I'm going to love this dinner with my family, but I also might enjoy that same amount of funds. And this is one stupid example. Like one dinner doesn't really matter in the grand scheme of things. But if you do enough of it, if you're smart about allocating and you get 3 times your money with this huge dividend in my specific example, like I get excited about that. I actually go, this is a deal and I got to go get me some of that. So it's not an easy thing to just generate more cash to allocate, but it's simple at the end of the day. It's you sacrifice other expenditures, you pull from other buckets that maybe aren't, that's not the direct cause of it. If you're really excited, if this is a once in a decade type event, for most people, you should just dollar cost average in and be excited about the fact that if markets are down and you're dollar cost averaging in every month from your paycheck, you're buying more of the same thing that you were buying 6 months ago or 2 years ago. And that's going to end up in a great situation for you. You don't have to change the way you live your life. But for nerds like us, we might reallocate some funds from other creative places.
Word. Cool. All right. Well, as Skippy mentioned, skippydoogles@gmail.com. Hit us up with that listener mail. Please go rate and review the podcast. If you go to skippydoogles.com, which we don't talk about as frequently, that's our one-stop shop. You can see all the links to all the things you can do, including premium subscriptions, etc. So please go check that out. And thank you for listening.
Thanks, guys.